Welcome to the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Cavanna. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors podcast. I'm your host, Kieran Cavanna of Old Farm Partners. Our goal is to bring you great investors and the themes they're working on. Some are under the radar, and we think all of them are experts in their disciplines. This podcast is sponsored by Vidrio Financial. Lucky for us, we have one of the best small cap managers in the US, arguably, to talk to us today, James Davolos. Welcome, James.
Thanks so much for having me, Kieran.
Well, James joined Horizon Kinetics in 2005 and currently serves as the co-PM of the Inflation Beneficiaries ETF. Ticker for that is INFL. He's also the PM of the Internet Fund, as well as several private funds. James worked his way up through the trading desk, then research, and now is running funds. His small cap fund in 2022 was the number one performing fund out of 1,400 that year. And you can read the Art Barron's article about it if you want to Google it. He's definitely a rising star in the value world. And a little bit about Horizon Kinetics. It's a really interesting firm. It's founded by Murray Stahl. It manages about $6.5 billion, and they have a number of different funds and ETFs. They're an eclectic firm that is, in the last decade that I've known them, to span buying physical diamonds, buying companies with massive tracts of lands in Texas, as well as directly funding Bitcoin mining. I'm very excited to talk to James about what he thinks and the years ahead in investing. So James, let's kick it off. What do you think? I'd love a little bit about your background and how you got to this point. Maybe we could just start off there and go through your history briefly, and then we'll get into some ideas.
Going way back, I grew up as my parents were small business owners, small motels on the New Jersey shore. And we basically all worked all different functions, whether it's the front desk, cleaning the pool, doing activities for the guests. I kind of learned the hard way, even though I was really young at the time. But my dad, I think he had 7 or 8 properties, and he had them all cross-collateralized during the S&L crisis, and basically went from being fairly significantly wealthy to fighting for one lone property to basically remain solvent whatsoever. And he passed away, and my mother, who had no business background whatsoever, through just, I think, tenacity, blood, sweat, and tears, ultimately was able to keep the property in the family, but learned all about bookkeeping, learned about P&L, learned about unit cost economics, and learned the hard way about leverage and matching duration of debts. But so that was my crash course. And so it was obviously fairly natural that I was going to go into business. Studied undergrad at Loyola in Maryland and got really lucky to end up on the trading desk at Horizon in 2005, which was the boom years for value managers. I think when I started in late 2005, the firm had about 10 billion of assets. The next year it doubled to 20. The next year it doubled to 40. I thought I was going to just be the next Stan Druckenmiller or Julian Robertson. And then, 2008 happened and sobered up real quick. So from there, got my MBA at night in New York while I was still able to work at the firm. And Peter Doyle is my mentor. Murray's the CIO. And just been a really incredible experience where they've taken someone who didn't have probably the requisite skills to have joined a more conventional firm and cultivated me in their style and unorthodox investing style. And almost 20 years later, here I am.
Wow, that is some story. And I think it really is so interesting how past experience, obviously how you grew up, really doesn't affect how you're an investor. I see it all the time. But that's some great story. So James, let's get into it. It seems like you're reasonably focused on inflation these days, and you run a pretty big strategy focused around inflation. And you mentioned in one of your write-ups about how they're echoes of 1972, which as a 1972 baby, you were not around then. So I'm not sure that you're qualified to talk about it. But let's just get right into it, if you don't mind. I'd love to hear what you think about inflation today. I know it's a pretty complicated topic, but what do you think and how are you investing?
Yeah, I was nowhere near being on this earth yet in 1972. So I got a little bit of friendly heckling when I wrote that letter. But reading Buffett, Munger, Graham, Dodd, all the greats, the number one lesson is you really need to understand history to understand the present. And while we definitely didn't want to make a quote directional inflation call, we'd been concerned for a while that the investment landscape was shifting and that ultimately there was going to be some sort of a break from this Goldilocks scenario of low inflation, low vol, low rates, low real rates, which basically just meant everything went up with, I don't want to say no vol, but certainly episodic vol that just kind of straightened back out to trend. This was really manifested probably in the 2015 period where we were just banging our heads against the wall looking at things that we thought were really overvalued. To be honest, some of them ended up growing into their valuations, many did not. But we thought that the market was definitely becoming more and more inefficient. Indexation had a lot to do with that, but also all of those pre-existing variables. We zoom out, we see interest rates are extremely low. We see M2 money supply is running about 6% a year. And even after the crisis deficits, which were 8, 9, 10% during '08, 9, and 10, we were still running 3 and 4% deficits. So if you call those all kind of demand side drivers, on the supply side, we noticed, so this was right after shale kind of broke the oil market, and you still had not seen any type of rebalancing in base metals. Precious metals were kind of going through some fits and starts around sovereign debt, but really vast underinvestment on a lot of these supply side variables. And so we came to the conclusion that this is a slow burning fire, but eventually something's going to crack, and you have a supply side argument colliding with a demand side. Bring 71 to present day. You go back to 1971 at the end of the year, what's now referred to as the Nixon shock. They meet at Bretton Woods. The most famous part of that meeting was we removed the convertibility of the dollar into gold. So the dollar henceforth was a fiat currency, but we also implemented price and wage controls, which were targeted at then low but rising inflation. Next thing you know, that creates obviously a very vulnerable situation, particularly the gold standard removal. A couple of years later, you get the OPEC oil embargo. Oil goes from 3.5 to 11. Inflationary recession goes right back to trend. And then again, you have another blowout in inflation and oil with the Iranian Revolution in 1979. But my argument is that those preconditions made the system very vulnerable to these inflationary shocks. Looking at 2020, which really is an extension of 2008, where this QE dynamic and this dependence on financial stability, particularly in credit markets, that sets the stage for some form of stability down the road. But in 2020, we basically went into this QE infinity, or basically admitting to markets whenever something major happens, we're just going to throw mountains of money at it. It happened before 2020. In 2019, there was the reverse repo market freeze up, and we just poured money at that. Obviously, we needed to do something extreme for COVID and the pandemic, but following 2020, following the stabilization of markets, we've never normalized the deficit spending. Even though we peaked at 12% during the middle of the pandemic, we're forecast to run 6% deficits for the next decade. So that's $2 to $3 trillion a year. So you've got this dominance on the fiscal side. You also now have the Fed telling you that a lot of the bonds that they purchased are now permanent because they need that liquidity to manage markets. And again, you have this mandate for financial stability. So all of these preconditions, we think, are setting a similar inflection point for a new structural regime of higher volatile inflation, which is going to require a very different playbook than the last 5, 10, 15, 20 years, which has basically just been lever your growth beta.
Do you think, though, James, that since the deficit was 10 trillion and now here we are 33 trillion, and it's very hard to pinpoint when that happens, when there's an inflection point, and maybe it is rising rates because now debt service is a huge issue. We'll spend more on debt service at some point than we do in the military. But do you think that, well, that's the macro conditions, but how do you invest? Because you're a bottom-up investor, right? You don't buy anything without doing bottom-up research.
Yeah, look, I hate that. Not, I don't hate, but we have these strategies that might sound as if there's a top-down theme. And I think that over the years, we've had a lot of top-down investment verticals, but they're all originated from some bottom-up thesis and then reconciled back to this fundamental analysis. And the world that we're envisioning is a world of scarcity versus a world of abundance. And so you're really going to need to focus on balance sheet and balance sheet value. That's generally going to be in real asset companies. But again, you then need to look at the business model. And so look at real asset business models that can protect operating margins, have operating leverage, and can increase shareholder value by virtue of cash flow, replacement value, dividends, et cetera. And that sounds like not that tall of a task, but when you actually stress test a lot of the businesses in the marketplace, very few have the ability to preserve value and grow cash flow in the type of macro regime shift that we think we're in the middle of. And lo and behold, most people and asset allocators have little to no exposure to these businesses, sub-industries, and sectors.
It's true. I mean, I think you and I first encounter, I'd love to get into this one idea that I think when we talk, there's this company called Texas Pacific Land. I don't know how specifically you can talk about it. I know you guys are heavily involved with this company, but it's one of the more extraordinary situations, which when it's a $12 billion market cap company today that no one really has heard of, there is very little sell side coverage. And what impressed me so much when we met a long time ago was how much work you guys did, primary research. I mean, literally going to courthouses to figure out what land was owned by whom. Maybe you could dig a little bit into that, just give us an idea of what kind of work you do. And this is very much a real asset name, isn't it?
Yeah, probably the best. It combines the two best real assets on earth. One is raw land, the other is royalties. But to give a little bit of a background on the company, it was a liquidating trust that was created in 1888 to basically sell the land that the bondholders seized with the bankruptcy of the Texas and Pacific Railroad. So this railroad was supposed to connect Texas through Southern California, and the government granted them land in an alternating checkerboard pattern as they completed each mile of rail. They never made it past the western extremity of Texas. Maybe if they did, it was only marginally. And so this company had this 3 million acre land bank. And ultimately, it was proven to be smack dab in the middle of the Permian Basin, specifically the Delaware Basin, which is arguably the most important oil producing region in the world, eclipsing even the importance perhaps of Saudi Arabia, given how dynamic the production is and how large the production is. But when Murray found the company, and I think all credit needs to go to him for finding it, he recognized a very unique variable, which is that the company had some oil and gas royalties, but it wasn't really significant. They had these millions of acres of land, and they were able to sell the land, not a tremendous amount, a couple acres here and there. But then they would use that cash to retire the stock. And so let's say you were selling acres at $1,000 an acre, but then you could retire stock at an implied value of 200 an acre. It was basically this perpetual compounding NAV machine. He also recognized that the Permian was a very prolific oil producing region in the 1970s. But once we exhausted conventional pressure reserves, the basin had gone into basically terminal decline, but we knew there was a lot of oil there. It was just a function of time arbitrage until the oil was ultimately figured out how to get it out. And now, obviously, they figured out in a very extreme way how to get oil out of that land. But to your point about work and unconventional data methods. So, this was originally a trust, three trustees appointed for life. They basically give you very limited information in these archaic annual reports. And, you could call them up and maybe they'd talk to you. They had a general agent as a manager, but you really needed to get the information yourself. And, we could pull courthouse data, we could pull well data, but ultimately, the biggest, I think, delta was that we did know that at one point in time, the company did own the oil-bearing land as opposed to having a royalty on it. But it was separated in 1952 into a company called TXL Oil. That company was public, I believe, for 4 or 5 years, between 51 and 56. And we were clamoring to get our hands on the annual reports. And so I scoured the earth looking for these annual reports, and I found them. I found one library that had a copy of them all physically. And it was in Menlo Park, California, of all places, at Stanford University. So I, at the time, was actually a graduate student at NYU, and I submitted a request to borrow the documents via the NYU library, where I was able to view them and photocopy them, but they could not leave the premises at NYU. So ultimately, we got our hands on 5 years of annual reports for the company that actually operated the acreage that was just then becoming a major hydrocarbon bearing region. And ultimately, TXL was sold to Texaco. Texaco was consolidated by Chevron. So now Chevron is the largest owner, although there's a large disparate pack of operators due to kind of a lot of different reasons and how oil acreage is broken up over the years. But I think that gives just a great example of alternative data. Yeah.
Yeah, great story. I mean, it's a 12 billion market cap today, but what do you think roughly? You've been working on it for 10 years. What do you think it was at one point when you first started working on it?
Oof. Let's see. When Murray first started, it was sub $100 million market cap easily. Wow. When I was, maybe it was 200-300 million. It would bounce around a lot with the price of oil. But I mentioned earlier the power of the royalty business model and the power of land. I mean, I think people have seen Pershing Square's study on Irvine Ranch and what the compounding power of land has done. I mean, well, if you're waterfront in Southern California, obviously it's a bit more powerful, but broader studies have shown that as well. But royalties as well, where just a quick example, an anecdote of the power of royalties is, if you go back to the inception of the SPY, the first S&P 500 ETF in January of 1993, that has compounded with dividends at about 10% a year over the last, call it 31 years. Mesabi Trust, a little iron ore trust in Minnesota, has compounded at 18%. Sabine Royalty, a passive royalty in Texas, has compounded just shy of 16%. Meanwhile, iron and oil have compounded at 8 and 4. So when you look at those compounded rates of return over 31 years, so the S&P, you've done 19x on your money. The iron ore royalty, you've done 170x. The oil royalty, you've done almost 90x.
What do you think, though, now that you've talked about in the macro conditions for basically new regime and maybe scarcity of capital, right? And that's, so I want to go for it, but I'm sure these names populate your portfolio. I don't know to what degree, but overall, I mean, do you think that these are the best days are ahead for these type of things? That's what's happened, right? You look backwards, but now we're moving into this new regime.
I think that going forward, a lot of the investment community, well, most people don't even care about a lot of these end sectors because they're just paint by number with beta, growth, value, dividend. But if you do go into a rising price environment and you do have fewer new supply coming on, which we are starting to see in some markets more significantly than other, the fact that these royalty companies and raw land companies, at its core, their incremental margins are 100% because you basically have this enormous resource base that you've had for decades. And so as everyone else is clamoring to get their hands on new supply, you already have the incumbent asset as the prices rise. So the beauty of it is that while volume and the price of the underlying asset, so volume times price is your revenue function, your cost of goods sold doesn't move at all. So a lot of these royalties have gross margins of 90% or better, operating margins not that much lower, and then fully taxed net margins can be 60 to 70%. And I think that is going to be one of the most critical variables, if you agree with this thesis, is who can actually maintain margins during an era when labor's going up, when reinvestment capex costs are going up, when transportation costs, when debt financing. So that's going to be a really difficult factor to model when people are looking at more traditional real asset businesses.
I know you've written about potentially, and we've touched on this about a commodity super cycle, and you're talking about commodities, but is there anything else that you could throw into that mix that you think could make it more probable?
Yeah, I think going back to kind of the macro thesis where with the financial stability argument, and let's say something does happen that's destabilizing, whether it's geopolitical, whether it's something in one of these opaque markets like private credit, I think that the bar has already been established that the government's just going to pour money at whatever this problem is. Whether it's conventional mechanisms, whether it's unconventional mechanisms, everything is just fought with more and more liquidity and more capital. And I think the world is gradually starting to realize this, and you're seeing it in discrete markets, even if it's not manifested in equities yet. Looking at gold holding over 2000 an ounce here, where really strong dollar environment, really strong interest rate, particularly real rates, those are gravity to gold, and gold is still holding 2000 an ounce. You have iron ore over $100 a ton. You have copper flirting with 8,000 a ton. These are not price levels that you would think are consistent with the narrative of China collapsing and this imminent recession, whether it's a soft landing or not. So I think the market is starting to sniff out store of value, especially in places where historically you can make a lot of money over prolonged periods of time as long as there's not a big supply response. But I think, again, the ultimate mitigating factor to whatever the thesis could be around a recession or a destabilizing event is they're just going to dump money. They're just going to pour money at the problem. So you might have some incremental vol, but it's the same, still the same end result.
Yeah, I mean, actually, in Bitcoin, right? You guys are very familiar with Bitcoin, and you see that moving. This has got to be part of it, maybe.
I wasn't sure if you wanted to go there, but
No, not. It's okay.
as we were sitting here today, I mean, I think it was up another 6 or 7%. But again, yeah, I think that's another one that's sniffing out what the governments are doing. Obviously, the ETFs might be playing a role, but that's another great indicator of these discrete variables versus equities, but the opportunities in the equities because they've gotten so cheap.
Actually, related to this, I know you've written about this too, that you're just not buying this concept of immaculate deflation, that we're just going to basically soft landing, right? And maybe you could talk about that a little bit, because I think that is conventional wisdom today, is that things are going to be just fine. The Fed's doing its job, and we're going to ease into a reasonable balance between growth and lowering interest rates. But what do you think?
I think that's why I forget the bottom. There was a short-term bottom in October of last year, and then the market was just grinding higher. And then you have the December Fed meeting, and we just fly into the end of the year. And then this year basically continued that trend unabated. And the narrative has basically been rate cuts where we can cut rates, and then the economy doesn't necessarily decelerate to a meaningful degree. I think the definition of a soft landing is vague. Maybe it means a very mild recession. Maybe it means no recession. Anyway, there's a very telling interview with one of the voting Fed members, rather than mentioning his name, but to pick on him. But he went on a podcast specifically calling for immaculate disinflation. And his logic was as follows. CPIs in the 90s and early 2000s was right around 2. And you've got shelter, which was running high, 4, 5, 6%. Services were actually running high as well, not as high. So let's call it 3, 4, 5. But then you had goods, and these goods prices were basically this lead weight. And so they were basically flat. So his argument is, look, we're seeing progress on shelter. It's coming down 3, 4, whatever. We're seeing progress on services 3, 4, 5. And eventually goods are going to come right back down 2, and we're going to go back to 2. We can cut rates and then everything's going to be great. There was no discussion about why goods prices were disinflationary over that period. And so go back to the 90s, basically the beginning of globalization. You had massive mobilization of resources and labor, particularly from China, Southeast Asia, South America. So, we flooded the market with cheap labor and cheap goods and cheap resources. We also had this thing called the internet, which created a step function in productivity growth, which also was inherently disinflationary. Other technological kind of advances in metals and mining technology, fertilizer technology, higher yields on arable land. It was almost this perfect harmony of factors for a disinflationary growth environment, yet we were still around 2. But again, this Fed governor is saying we're going to go right back there. And if you look at all the variables that contributed to goods disinflation, almost everyone is ending or reversing today.
Particularly globalization. It's not ending, it's changing, right? I mean, I think about this quite a bit. It's something I'm sensitive to as an investor as well. A TV today costs nominally what it did 30 years ago. It should be 5x. Anyway, but we'll see. I don't know if it reverses, but maybe it moves. Is that fair?
Exactly. You're seeing onshoring certainly of important industries. I think it was a big wake-up call for everybody about how reliant global supply chains were for things like pharmaceuticals and antibiotics during the pandemic. But then you're seeing a lot of protectionism around rare earth materials, semiconductors, and that's going to be inflationary. You're also seeing it around, we've seen export quotas and bans on things like palm oil, on things like grains. And I think that's only been going to become more and more common when you do see stress in global markets. And then, unfortunately, wealthy countries are going to be able to bid that up. So when gas was at crazy prices 2 years ago, Europe got gas. It was countries that couldn't afford it. And I think that's going to be the recurring theme with protectionism and onshoring and friendshoring.
And, non-politically, Trump presidency again would clearly amp those things up again. You could see some pretty intense moves. I want to shift to another thing because AI, I remember you said that it reminds you of the fiber build out from 2000 to 2002. Does that mean that you think there's elements to it that's a fad?
Yeah, look, I'll caveat this by saying we're not experts. And obviously, I think that there's going to be some pretty big advancements, and there's some areas that it could have profound impacts on, such as pharmaceutical research and medical research. And let's hope for society that ends up being the case. But if you study the internet era, while there were a lot of businesses that just were not legitimate businesses, pets.com and things like that just were never going to make money. They weren't viable businesses. There were these incredible businesses that were laying all this fiber, and a lot of people kind of thought that's the backbone of the internet. That's where all the money should be made. And ultimately, those fiber companies have been bankrupt. I think they've been restructured 5 or 6 times. And actually, it's funny, here in Connecticut now, Frontier is actually laying their own fiber, or they're doing last mile, where it used to just be the backbone. But the point is that all this fiber was theoretically going to be worth trillions of dollars connecting all the bandwidth of the internet. And here we are 25 years later, and it's marginally profitable after 5 restructurings. And it's hard not to see parallels with redundant AI data center hyperscalers doing the same work. And again, certain use cases, absolutely, but is it going to be this step function change in productivity? I still don't see the result. It's pretty good at creating cool images. It's pretty good at letting kids cheat on their homework. And unfortunately, I think a lot of the easiest gains from AI is going to be replacing redundant or unproductive labor. But then if you look at the equation for economic growth, where you gain on productivity, you lose on labor force participation. So You could see some corporate profits juiced, but economically and the country as a whole, is there a full net benefit?
We will say a lot of people disagree with you, but that's okay. That's what makes markets. A little bit more. Can we talk about what you like? I mean, we talked a little bit about it, royalty businesses and such. I'd love to get into that a little bit more. You're a hard asset investor, but you've also talked about businesses that are capital light that you like quite a bit, or hard asset and capital light. Maybe you could describe that more and why you think those things could see the next really great returns over the next 3 years.
Yeah. And so I'd say that one of the commonalities at Horizon for my almost 20 years here is it's always been about finding the advantaged business model and then valuing it appropriately. And one of the most important things when you look at real assets is they're very capital intensive businesses. So whether you're looking at the natural resource side, you spend a lot of OpEx up front to base it, or excuse me, CapEx up front to get the assets up and running. Then there's a lot of incremental OpEx, and then you have to reinvest that. Then when you look at real estate and infrastructure, same thing, where there's a lot of initial upfront investment, but then also there's a tremendous rate sensitivity because a lot of these businesses have become rate proxies in the prior era of extremely low interest rates. There's some incredible businesses within these universes, but whether the valuation due to it being a rate proxy, the capital intensity, the reinvestment limitations, it's not as easy as just painting by numbers. So we overlay what we call the capital light business model. So find the businesses that have an advantaged business model where they can remain profitable, they can scale, and they have less or limited sensitivity to all those variables I mentioned that are in the conventional real asset space. I think it's difficult to categorize these companies in any one blanket form, but I'd say that the intermediary or toll booth or spread-based businesses tend to be a big area of focus. So we mentioned the royalties earlier. At the end of the day, it's really a toll booth. It's more volume, whether it's oil, gas, copper, gold, silver, soybeans, whatever it is. More volume equals more revenue. Higher price of the underlying commodity also means higher revenue. When you get both, you have this dual impact of higher revenue. And again, a pure royalty business is nothing more than basically an accounting department, maybe some FP&A people, and a couple people to evaluate some acquisitions here and there. Margins are, again, incredibly high, and the reinvestment risk is not nearly what it is, nor is the operating expense exposure. So you can see how these companies can do great without rising volume or prices, just given the nature of the business model. If you're getting distributions, if you're buying back stock, if you're managing the business properly, and you buy it at the right valuation, but then you have this incrementally much higher return profile depending on that kind of sensitivity of volume rising, price rising, and valuation spreads maybe narrowing a bit. Some other areas that I think are incredibly interesting that are within that intermediary would be financial exchanges. So financial exchanges is something that Horizon's been involved in for, again, over 20, 25 years, where you could have made a retire on the beach fortune if you just bought up all of these seats on exchanges around the world as they demutualized. So in the old days, all of the member firms and traders would have seats, whether it was the Chicago Board of Trade, Chicago Mercantile Exchange, NYMEX, New York Stock Exchange, and then globally you've got London Stock Exchange, ASX, just to name a few, Bovespa down in Brazil. They were previously almost clubs where they were not necessarily, they were incredibly profitable, but they were more run for the benefit of the members themselves. They demutualized in the early to mid 2000s. And this coincided with an incredible trend for exchanges, which was the automation and technological implementation in financial markets. So if a bunch of people running around in a trading pit in Chicago could trade 1 million contracts a day, just imagine what a bunch of supercomputers that are plugged right into the exchange could do. So again, it was this tremendous harmonious event of these things demutualizing as these big secular tailwinds were coming. But again, looking at what an exchange is today, they're basically financial supercomputers matching buyers and sellers, taking zero principal risk. So it's that same toll booth, volume times price. Whereas the exchange, it's much more sensitive to volume because price is a lot less dynamic. But your incremental cost of revenue approaches zero if your volume is growing by trillions of dollars. And one of the best aspects that's underappreciated about exchanges is that if you look at the past 20 years where the data is available, volumes across the board tend to grow several hundred basis points in excess of nominal GDP. So you have this business that organically grows at a spread to nominal growth. And then your cost structure is somewhat insulated from expenses because a lot of it is just an automated computer program. So these are just incredible businesses. There's all this product innovation. I mean, I'm not saying it's good for society or good for financial markets, but these zero data expiration options, and now you're seeing futures in all kinds of different products where you are seeing a bit more of a casino aspect, but regulated on these exchanges. I'd much rather own the CME than own, the people that are speculating on these short-term and short duration derivatives. But again, you can see how these businesses would thrive in a high nominal, even if it's a low real growth environment. But also the biggest derivatives markets are currencies, interest rates, commodities, index futures. And so, what markets have the biggest deltas to inflation break evens? Well, it's the biggest profit drivers of the derivatives exchanges themselves.
And it's probably a good, it's complementary to the hard asset, the iron ore, the gold, right? I mean, they probably are not correlated, I would imagine.
Yeah, that's one of the great aspects of the portfolio is that you've got your more traditional real assets, but then you go into these capital light compounders in financials, industrials, healthcare, automotives, and that makes it much less of a directional bet on a sub-industry and a portfolio that can perform uniquely through full cycles. So the way that I like to describe it is when you combine all these companies in one portfolio, it really makes it a full cycle or a long-term allocation rather than trying to express a bet on real assets, rates, or both.
Yeah, fair point. And it's interesting because, we also invest in macro funds, and the more bearish macro funds have your kind of views on monetary policy and where we are and deficit spending and all that stuff. But that makes them very bearish, right? And that's not how you invest, right? You're just trying to, those are the conditions. And then you're trying to find things that will work within those conditions. Is that fair?
Yeah, that's 100%. I mean, we think that there are the market. I think those global macro funds are probably saying, look, markets are not cheap.
Yeah.
You can argue somewhere on that spectrum between bubble and fair value, but I think very few people would say that you're below fair value.
Right.
But if this is we're an equity fund, we're equity managers. So in these conditions, what can and is very likely to work? And that's kind of what we've solved for.
I remember a legend in this business. I was at a conference and Paul Singer said, I've been bearish since 1975, but I'm a billionaire. And they said, well, he followed up with, well, everybody else who was bearish sold their homes and bought gold. And all I did is try to find sure things, which is actually, I thought that was pretty pithy. So yeah, I mean, balancing macro and top down are pretty important, right? And in an environment where equity, even though you're net long, obviously, equity markets are weak, you would expect these to hold up to some degree.
That's also kind of how you can manage the portfolio. In a variety of bad markets per se, you could have the precious metal exposure doing incredibly well. Exchanges thrive under volatility because volatility is one of the biggest drivers of volume. There's even kind of more stagflationary environments, which might be what the macro funds are looking at, where almost everything in this portfolio would do well, which would be a lot more challenging for the broader market. And so I wouldn't go as far, nor do I have the credibility of Paul Singer to say it's a sure thing, but I think that there's a lot of environments where a lot of these companies make a lot of sense.
Right. What do you think? I mean, just try to foretell the future, which is no one can. But I'd love to know, given your views, where do you think, I've been watching this for a long time myself, and where would the credit cycle end? The debt cycle, the credit cycle, because basically I think after '08, we did learn that the Fed will come to the rescue. Some of the more smart macro guys that I know think that there just may be a time when the Fed doesn't even have that ability. But I'm not bearish, and I don't think you're very bearish, but how would it end?
Yeah, I mean, that's a really difficult concept to think through because, again, if the Fed is kind of always there backstopping credit events, Silicon Valley Bank, where's the moral hazard? And actually, one of the interesting things, and it was in our annual letter, is I went back, and I think people would love it if they went back. I don't know if you have show notes, we could put it in there, but Warren Buffett wrote an op-ed in the New York Times in 2008 called The Greenback Effect, where he was absolutely mortified by the fiscal situation in 2008 in response to the global financial crisis. And he likened the greenback dollar effect to the butterfly effect, where if you go back in time and change these variables, there's this spiraling effect. And basically, he kind of went to the Hyman Minsky logic where, it doesn't matter until it is. Everything is most unstable when it appears the most stable. And so, honestly, I don't know. I think that the cure to the problem, unfortunately, kills the patient, which you need to somehow balance the budget, but there's really only austerity will do that. I think austerity would collapse the economy. The other way to basically solve the debt problem is default. Let's assume that's completely off the table. So then you have debase, and debase is varying degrees of inflation, debt, monetization, MMT. I'm not sure where we are on that spectrum, but what I try to think through philosophically, is there a point in the road at which policy doesn't fix it? I mean, is the system just too big and too interconnected, almost like in '08, where it was maybe even dicey if they could throw enough money at that problem? And honestly, I don't know, but that would go back to kind of an '08 scenario where it's the entire financial system at risk.
Let's hope not. Let's never go through that again. And last thing I wanted to go through is a little bit, because you guys are one eclectic and interesting firm. I think Horizon has a great reputation. Murray's been doing it for a long time, has a phenomenal reputation and attracting talent. How do you decide what to actually focus on? I mean, literally, I've looked at Bitcoin mining funds that you've done. I know you did this diamond fund. You have your inflation beneficiary strategy. It's been pretty successful. I mean, how do you decide? Is it risk reward driven, or do you just, because when you could do anything, how do you choose what to do?
Yeah, good question. I'd say there's the core competencies. And I think our core competency are these high quality value compounding businesses, these capital light hard asset companies. That's the core competency at the firm. And that's probably 70, 80, depending on where we're at in the cycle of what we do. But kind of the beauty of being a boutique with a broad mandate is that we can do opportunistic things. Similar to your firm, I'd say that the most opportunity tends to be in these very idiosyncratic, often time-sensitive opportunities where there's an inefficiency. Murray is a very unique thinker. Everyone at our firm has been humbled by the amount of breadth that he can cover with incredible detail. I don't know if he has a photographic memory, but if he doesn't, it's pretty darn close. And I think that he picks up on things and can find opportunities that I think a lot of other people wouldn't. And then he has people like Steve Bregman, Peter Doyle, myself, and the rest of the team that can kind of chase down these one-offs, which sometimes are the most compelling opportunities out there. Beyond that, it's all about just looking for asymmetries. I'd say, to sum up the investment landscape, probably all the time, but particularly today, is can you underwrite something where you get a reasonable, okay rate of return under the base case, but then you've got all this free upside if things work out in your favor?
And nothing like hard work to find those things. So I know you guys work very hard. So James, this is great. I think it's really interesting. And James, again, works at Horizon Kinetics and has done a great job there for a while, and somebody to watch in this business, I think.
Thanks, Kieran. It's been a lot of fun. I really appreciate having me on.
Same here. Take care. Thanks, James.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.